Hi, everyone. It's Isabel Valley again. You know how everyone says taxes are confusing and boring. Well, they're actually right. But this new tax law might just put money back in your pocket. So let's break it down what you need to know without hopefully making your brain hurt. Okay. This will be a quick and easy presentation, and hopefully one that will literally, no doubt, no clickbait. This is going to save you thousands, thousands on taxes. It could literally make your tax bill zero, as in no liability. So listen up. So, as you all know, unless you've been living underneath a rock, the government just passed something called the One Big Beautiful Bill, and it is packed with changes that affect both your business and your personal finances. So, after you hear all this today, you may be calling the One Big Beautiful Bill the Online Biz Beautiful Bill. So if you sell products online, whether it's dog collars, supplements, or handmade soap, these new rules matter to your bottom line, and it might be in a really big way. So there are a lot of fresh deductions, vehicle purchase perks, and credits that, if applied correctly, especially if you are ahead of the game and start working on this now before or after December 31st, when it's too late, you can save some serious cash. So, wait, and this is really shocking. Do you know that you can actually write off your all of it, all of the business equipment and vehicles purchased this year? But I'm jumping ahead of myself. So let's dive into the implications of e-com businesses and you personally as the owner of these businesses on this One Big Beautiful Bill, as we call a OBBBB. So let's start off with the business side of things, okay? And let me move forward here. Hold on just a second so I can get you guys forward. All right, I like to start off with the best part of the business side of things, which, if I can make it work, is the QBI. So QBI, for those of you that don't know, whatever you make in your business, 20% of it is not taxable according to the QBI. And obviously there's certain restrictions and limitations on it, but for the most part, a lot of you guys get the full 20%. And it has been made permanent. And by the way, when things are said permanent, and you're going to hear that word thrown a lot when it comes to these taxes, nothing's permanent. Congress can always change things if they wish, but I digress. Okay, so 20% is still in effect for your QBI as it was last year. Okay, and there's been words thrown out that it's 23%. It's not, it's 20%. Okay, now here's the stuff that I absolutely am like, woohoo, crazy about, because I know I'm going to save my clients tons of money this year because of this. It is the bonus depreciation. So if you recall, many years ago, bonus depreciation was at 100%. That means whatever you bought, 100% of it was expensed or depreciated the year you bought it. So nice to a certain extent, but the limits are so high, it's ridiculous. It's back. It was supposed to go down to 40% of whatever you bought this year, but no, it is back to 100%. Nice. And so basically what it means is that you can write off the whole value of that fancy new laptop or the warehouse robot or whatever in 1 year. Boom. So no more stretching it out for 5 years, which is what is typically amortized at. So you get like, if you buy something for $50,000, you can only take $10,000 for 5 years to finally expense it out. Now you get the whole thing, instant gratification with tax savings. That, on top of that, in addition, they set this Section 179 depreciation, which is a beautiful thing in itself. They doubled doubled the limit. So now it's 2.5 million per year. And this is great for large e-commerce sellers investing in automation or upgrading their facilities. And both of those, like I said, both of these tax regulations can be used in a single year. And there are slight differences between them. And I wanted to give you guys a really quick and dirty cheat sheet. So one of the things I wanted you to notice here is this loss here. Know that the Section 179 cannot trigger a loss. That means if you netted out, let's say $100,000 this year, and you bought $200,000 worth of equipment, you can only use $100,000 to deduct, making your net income zero. You can't go above and beyond that and create a loss. But with bonus, you can. So why is that important? Well, let's say you had two businesses, right? Let's say one business made $100,000 and the other business, because of bonus, made negative $100,000 because you bought so much equipment and you wrote it off. Guess how much you made overall? Zero, which means zero in taxes. See how nice it is to have bonus depreciation? You can go to a zero. You can go to a negative number, which can offset a positive number if you have another business on the side. Beautiful. Okay, so here's a little other differences to note that Section 179 is capped at 1.25, $1,250,000. So if you bought a $1,250,000 piece of equipment, that's all you can use for 179. With bonus, not so. No cap, 100% beautiful. Okay. Let's say also scenarios you're going to buy an SUV this year for your business. At 179, you can only take $31,300 for that SUV, but you can also do this, which is a hybrid of 179 plus the bonus. With bonus, you can tack on another $8,000 to that $31,300. So what I would do is I would give you a Section 179 depreciation deduction, and then I'd tack on another $8,000 with the bonus. So overall, $39,300 that I could take off in one shot for that beautiful little SUV you bought for your business. Okay. There's other different distinctions from Section 179, and they're all here, and I don't want to bore you or make you fall asleep, so I won't go over them, but I covered the most important stuff. Okay. Now let's move on. What else did they give us? Well, there are these extra write-offs. Now, if there is a year that you have decided to get creative and either, develop some custom packaging, or you test a new product formula, or you're building out a brand new label, like a private label of some kind, and you're making it distinct and customized to your business, or even if you're experimenting with AI tools, like let's say to forecast inventory. And here's a selfish plug. We can help you with that. That's an R&D expense, and you can deduct all the costs, including the cost that we would charge for the whole year as a tax deduction. So before you had to wait 5 years, you had to take little by little in 5-year chunks. In 1-year chunks for 5 years, but not anymore. Now here's the big one. This is the mind-blowing one. This is the one I was like, oh my gosh, I cannot believe this. This is amazing. Okay, manufacturing facility write-off. Let's say you decided, hey, you know what? I'm going to start making my own widget or whatever it is that you sell, and you start to build your own manufacturing plant. You're building. Typically, a manufacturing building, it's 39 years to write it off. I won't even be alive in 39 years. Hopefully I will be. But 39 years to write it off. Not anymore. If you make a new building and you have, structures used in manufacturing or production, you can actually write the full thing, all of it this year. That is amazing. You wouldn't pay taxes. I mean, think about it. You're writing the whole thing off. You wouldn't have to pay taxes because this would basically take out the whole taxes. Okay, now I want to talk a little bit about payroll because I know there's all this talk about, hey, no tips on taxes, no tips on overtime. What does that mean for you as the employer? Absolutely nothing. You still have to pay employer taxes on the overtime and the tips. And by the way, just so we're clear, overtime is limited to $12,500 worth of overtime, and tips is limited to $25,000 overtime. The employee still pays taxes like state taxes and federal taxes on it. But when they finally do their tax return, they get that as a deduction on their overall taxable income. So they could possibly get a nice refund back. But no, for you as the employer, no, you do not get that off. You have to pay your employer taxes, your FICA taxes. That is not a deduction or credit for you specifically. There's also one other thing I wanted to mention, which is retirement and the 401k employee contributions. If you're running a 401k, went up to $23,500, right? That's pretty nice. That's the deferral amount. So if you're doing a traditional 401k, then $23,500 is deferred. Also, something that a lot of people have not been informed about is that starting in this year, January 1st, 2025, if you have 10 or more employees and you run a 401k for your company, you must have everybody auto enroll. They can opt out of it after you've enrolled them, but you have to have a trigger. You have to have a system in place that auto enrolls everybody. And then the employee can opt out. That just started on January 1st, 2025. So if you haven't done that, check with your HR service provider and see if you can get that established before you get fined and penalized. This doesn't apply to simple IRA. So if you run a simple IRA for your company, this an auto enrollment does not apply to simple IRAs, simple 401k IRAs. Okay, now one other thing, and this is kind of interesting, is called, this is more on the personal note, but if you have children, or you are planning to have children, have them in this year, next year, and 2028. Highly advised. And the reason being is because there's something called the Trump accounts. Yes, they really called it that. These are Roth style accounts that get $1,000 yearly federal match. So you can put up to 5K. They're Roth style. So whatever growth happens in these accounts, you don't pay taxes on them when you take it out. And the government's going to match you for the next 3 years, $1,000. It's a beautiful thing. When your kids come of age, they can use this for education, buying their first home. They can also use it for opening up a new business, like a online business or whatever business they're going to open up. But it's basically a jumpstart savings account for our future entrepreneurs of the world. Now, here is my absolute favorite going forward. If I can get this to work. It is the QSBS, Qualified Business Stock. Now, why am I showing you this? It's not for you to fall asleep or go cross-eyed. The reason why is that if you have ever dreamed of selling your e-com business and keeping more of that hard-earned cash in your hand when you retire or whenever you decide to stop working the business, but you want to sell it, here is your golden ticket, okay? So 5 years before you decide to sell, change your, if it's currently an S Corp, a partnership, an LLC, change the entity to a C Corp. We can help you with that, by the way, another selfish plug. If you do, and you wait 5 years while you hold it as a C Corp, and you sell it, any net profit that you made from the sale, instead of having to dish it out and give it to Uncle Sam, you can actually take up to 15 million of that profit tax free. Let me say that again. if you're S Corp, LLC, or partnership right now, and you change it to a C Corp, wait 5 years, hold it, sell it, and up to $15 million of that profit, 0 taxes have to be shared with the IRS. You get to keep all of that for yourself and your family. So it used to be 10 million and they just increased it to 15 million. So really just a beautiful thing. If you're planning to sell your company, just take note of that. It's something you have to plan for. Like I said, we help people out with this. But it really is just huge win. Think of $15 million of revenue, 0 taxes. Beautiful. Okay, so going on. I wanted to mention this because this could be very important. This is the reason why I did not advise any of my clients who didn't legitimately, qualify to take this ERC credit. They were handing these ERC credits out like lollipops. Like, everybody, you get an ERC credit. You get it. I was not a big fan because I noticed that unlike the PPP loans, this guy came with a little fine print. And that is, this is sort of like big time red flag on the radar excuse for an audit. And what happens, like I thought, the IRS is cracking down. So if you took the employee retention credit and it wasn't fully legitimate and complete with complete documentation attached and scoured through that actually qualified you for the ERC credit, the IRS is bringing out the magnifying glass. There's more audits, 0 tolerance for fraud, and the fines can be the greater of 200,000 or 75% of the ERC credit that they gave you. That's pretty tough. It's either that 200,000 or the greater. Oh. So, and also look at this. If you ever filed after January of 2024, like let's say you sent your application, you're still waiting to get the money, the IRS can just say, nope, not process it. Like, we're not going to even process it. Forget it, rejected, whatever. They don't have to process it. So they're really cracking down on this, guys. I know you guys have to be really cautious of this ERC credit crackdown that's coming up. They got to pay for these tax cuts somehow. And I think they're getting it from the ERC credit crackdown. Okay. And that comes with tons of penalties too and interest. Okay. So let's talk about personal taxes, more on a lighter note, and hopefully no one's fallen asleep yet. But this is really one of the most exciting parts. So, the joys of being an accountant to be able to talk about this. All right. So for those of you in the top tax tier, those people that make they have so much revenue that they're in the top tax tier. For those of you, know that you were supposed to go up to 39.6, but guess what? They stopped it. Yay! It is capped at 37. So you guys are capped at 37. So nice. So no change there. And then standard deductions went up. Yay! 15,750 if you're single and 31,500 if you are married. And then for seniors, this was really beautiful. So seniors also went up. So the singles went up to 2,000 and the married folk went up by 3,200. But in addition to that, if you make less than 75,000 single or 150,000 married, you get $6,000 bonus on top of the 2,000 or 3,200 if you're married. I never thought I'd say this, but boy, do I wish I was a senior right now. So jelly of these people right now. They're getting it good. Okay, more tax savings. Yay. All right, first, I like this one, charitable contributions. So you don't have to itemize for this. So usually you have to itemize to get a charitable deduction, contribution deduction. You don't have to. You can just on top of, go back. On top of this 15,750 and this 31,500 if you're married, if you give $1,000 if you're single or $2,000 to a charitable charity of your choice, you get to take that in addition to the standard deduction. So lovely. This happened during the COVID period, and now they reinstated it again. And side note, I am starting a accountant pain and suffering charity. So if you like to donate, please feel free to do so. That was a joke. I'm not really doing that, but anyway. Okay, SALT. So what is SALT? SALT is the expense that you pay on your state and local taxes. So think of property taxes. So this thing went up $40K. There was a time when it was unlimited, and I think it was supposed to get to be unlimited again, but they capped it at $40K. So even though it went up, because last year it was 10,000, this year is 40, but at one point it was unlimited. But regardless, you get up to $40,000 to take off if you itemize. That is, if you itemize for your, let's say, property taxes, your state property taxes. Now, for those of you that have a very generous heart and want to give to your children or your heirs, the estate tax exemption increased to $15 million. And by the way, I am up for adoption for anyone who can max out on this. So anyone who wants to adopt me, I'm here for adoption. If you can max out at 15 million. And then your annual, and by the way, that 15 million is per spouse. So if you're married, it's actually 30 million. And the gift is now at 20 million. So you do not have to pay taxes on 20K of gift giving. Yes, you pay the taxes if you give the gift, not your child. You pay the taxes, but you can deduct up to $40,000 for giving a gift if you're married, right? 20,000 each, 40,000 to your kids. All right, guys, and we're almost done here. So hopefully you stayed with me to the very end because this is the best part. All right. Just so you know, for those of you that are interested in getting that really pretty Tesla truck, if you're into that kind of stuff, or any kind of EV vehicle that qualifies, that $75,000 tax credit that you once were able to get, it is going by October 2025. So you have still a couple more months that you can buy that vehicle, and you can go ahead and get that $7,500 EV credet. Buy it now, because as I said, after October 25th, if you buy it, you're not going to get it. Also, just a little side note, because of the hassle that I had for the last few years with my clients that took this, make sure that dealer who sells you this EV files their paperwork. I would ask them for proof that they filed. Because if they don't, guess what? Even though you went, you had all this good intention, you got the vehicle, and you got this, and you qualified for the $7,500. If that dealer did not file their correct paperwork on time, and they get like a really short window to file, you don't get the credit. So be on top of your dealers and say, I want you to file immediately, and I want to see proof that you filed, so that you can get that credit. Now, here's the other one. This is the vehicle loan interest deduction. This is brand spanking new, just came out. Let's say you go out and you buy a new, has to be new, can't be old or used, a new vehicle that has been made, the final assembly has been made in the United States. So let's just say 90% of the assembly was made somewhere else, but the final assembly, that last bolt was actually screwed in the United States. If you buy that vehicle and it's new, up to $10,000 worth of interest on that loan payment that you made for that vehicle loan, the auto loan that you have, you can actually deduct from your income and have less of a tax bill, because you get up to $10,000. Here's a couple of cars that qualify, or I should say brands. There's certain cars within each of these brands that qualify, but obviously Ford, Chevy, Cadillac, GMC, Honda, and some Toyotas. So look into that. Also, you can't make more than 150K single or 250K married to qualify for this. So if you make more than that, you don't actually get this deduction. All right, guys. Thank you so much. Now, before you head off to the local dealership, I want to tell you something pretty important. Next week, you know how everyone's always chasing that that perfect e-commerce tech stack. And it's like, what kind of accounting software do I use? What kind of software do I use when I'm dealing with all these different sales channels, all these different payment processors? I got sales tax that I have to take care of. And oh my gosh, what about inventory? So if, okay, that overpriced software you bought last year is not cutting it out for you, and it probably isn't, and you're curious to know what the ideal tools are for 7 to 8 figure businesses, which are completely different from the tools that you use when you first start off as an online seller. Next week's live will break down the financial tech that gives you really clear visibility into your true profitability. Okay. This is the kind of tech stack that when you have, you sleep very well at night. You don't have a lot of worries. It's being taken care of. Everything is organized, controlled. They meet compliance rules. You don't have to worry about, surprises and unexpected fines and penalties because you didn't file this right. Or if you're trying to get, loans, let's say, because you want to take advantage of some of these tax credits and you want to purchase a vehicle, or you want to purchase equipment, or you want to make, or purchase another company, let's say, or another facility or somehow, and you need the documentation to give to the bank so they can approve you. All of that comes into play, that peace of mind and the ability to actually expand and grow really is an indicator of what kind of tech stack do you have controlling and organizing all of the workflows and transactions within your organization, and how well are you reporting them? So mark your calendars. Next Thursday, July 17th, I am going to reveal the secret sauce that our 6 to 8, 7 figure clients have used, not only to get to 6 to 7 figures, but to continue growing using this beautiful tech stack. So until then, I'm wishing each of you swift sales and sensational success. And thank you so much for staying with me so far. And I look forward to seeing you all then. Thank you. Have a good one. Bye-bye.